Hi, this is Yin Wai. I'm a senior fund manager with East Spring Investment Berhad, and I would like to share with you our small cap strategy going forward in the era of coronavirus. Coronavirus pandemic is a black swan event that no one had anticipated. The virus affected more than 200 countries with more than 800,000 cases reported worldwide. Lockdowns are implemented on an unprecedented scale globally. It will probably get worse before it gets better. And economic contagion is now spreading as fast as the disease itself. At the current rate, it looks like the coronavirus pandemic is set to be more severe than the H1N1 pandemic back in 2009. Investors were caught off guard. The intensity of selling was unprecedented. The S&P index erased gains that it accumulated for the past 3 years in just less than 3 weeks, with a decline of more than 30%. A pace that investors have not seen since the Great Depression. Fund outflows were seen across asset classes. Fears, anxieties, and panic set in as the world dealt with this new strain of virus. All we know that the new cases and number of deaths are escalating at a rapid pace. Investors have not experienced an outbreak that required such extensive lockdown on a global scale before, but economic damage has been done, and investors will need to be realistic about it. In the near term, we will only see downgrade revisions in GDP forecasts, downgrades of corporate earnings, and higher unemployment rate. Pressing questions include whether economies are able to return to their pre-shock output levels and growth rate, and whether there will be structural change in ways businesses are done. Consumer behaviors are also likely to change after a long period of social distancing. Central bankers have been proactive, slashing interest rates and unleashing fiscal stimulus packages to cushion the blow to their economies. Malaysia similarly has unveiled a stimulus package totaled 250 billion ringgit in March to help cushion the negative impact of coronavirus. Policymakers have been swift in ensuring adequate liquidity in the Malaysian market by cutting OPR and SSR rate in March, and hinted there's more room to do so if situation deteriorates from here. Apart from cushioning the blow to the economy, financial market regulators have also acted to help stabilizing the equity market. Key measures announced include suspending short selling and relaxing margin financing rules. Under current investment climate, how should a small cap investor move forward from here? Let us recap the basics of investors' emotion in a full investment cycle, from the start of a bull market to the end of bear market. Bull markets usually starts with optimism and ended in euphoria, whereas the down cycle starts progressing to pessimism and ended in despair. So the key question to ask us is, where are we now? Most of us would agree that we are already at the late stage of a down cycle, perhaps somewhere between the panic and the despair phase. We are somewhat entering the bottoming process. While stocks are trading much cheaper than before, investors will need to get assurance that the coronavirus pandemic is contained before they increase their bets. BM Small Cap Index has corrected to a level that is nearer to the previous crisis bottom, not very far off from the 2000 dot-com crisis and the 2008 global financial crisis. Notice that the steepness of the decline was unprecedented, exacerbated by the short selling and margin calls. This seemed to suggest that equities had to a certain extent priced in a deep recession. Similarly, previous recessions were accompanied by sharp decline in crude oil prices. Crude oil prices is currently trading at low $20 per barrel, similar to levels seen during the dot-com crash in 2000 and the global financial crisis in 2008. We ran an equity screening in Bloomberg for companies with a market cap below 5 billion ringgit, which is the market cap limit for our small cap funds. Out of the total nearly 1,000 stocks screened, the results showed that there are more than 880 companies trading below that threshold, and more than 400 other companies trading below a price to book of 0.5 times. Our investable universe has become bigger as the result of the current market sell-down. In terms of valuation, FBM small cap, in terms of price to earnings ratio, have corrected significantly. In times like this may not be a good indicator as consensus had not captured the potential downside in earnings. Hence, this is only a rough guide. A better indicator will be price to book ratio. The FBM Small Cap Index is trading near trial levels in terms of the price to book ratio. This will be a better measure to reflect companies' intrinsic values. We draw comfort that companies' balance sheets are much healthier as compared to the Asian financial crisis. We are unlikely to see much erosion in book value unless companies suffer losses for an extended period. In March, we saw sharply higher share buyback and insider buying activities. These two are powerful indicators that companies think that their shares are trading below their intrinsic value. China and Japan and Korea has demonstrated to us that COVID-19 could be contained with the right measures. Once the pandemic is contained, economic activities will rebound thereafter. Signs are telling us that we are nearer to market bottoms. Hence, the current sell-off presents great opportunity for the longer-term investors. Key downside risks, of course, will be the deterioration of coronavirus pandemic globally. Unsurprisingly, both of our small cap funds fell in tandem with the sharp plunge in local equity markets. However, both Eastspring small cap funds outperformed their respective benchmark during this market turmoil. We have always been very careful in selecting our small cap stocks with good balance sheet. They generally exhibit better resiliency during market downturns. The conventional small cap fund performed year to date better against the Islamic fund due to good performance from non-Sharia consumer stocks in the portfolio. We are comfortable with a cash level of 11 to 13% for now. Again, we'll be more comfortable in raising equity exposure when we see confirmations that the COVID-19 is contained. Not to say there are no challenges facing our small cap companies currently. These challenges include potentially weak global demand as many countries are still under lockdowns, and possible delays in construction projects again due to the change of new government. Expansion plans are likely to be delayed with companies trying to be conserving their cash. We expect consolidations to happen across industries with the dominant players emerging stronger after this crisis. Our preferred sector for now are healthcare, consumer staples, technology stocks, and dividend stocks, which are looking attractive again after the recent cuts in interest rate. Post-COVID-19, we think healthcare stocks to perform better as everyone practices healthier lifestyle and government starts to increase budget on their healthcare system. Consumer staples have been our preferred sector all along as these companies have strong cash flow and the ability to maintain a sustainable dividend yields. Meanwhile, we are confident that the bullish structural trend in the technology like Internet of Things, enterprise storage, and 5G will resume their growth path when the economy rebounds. Crisis creates opportunities. It's only in crisis that good quality stocks sell at discounted price. Investors should take a longer term view and look beyond this crisis.